Somewhere inside a secure conference room in Beijing's Zongnanhai compound, a decision was made. No press release was issued. No diplomatic note was exchanged. No financial journalist received a leak. And yet, in the quiet precision of that room, the most consequential financial repositioning since Bretton Woods began to take shape. The man who authorized that decision was not a general. He was not a foreign minister. He was the governor of the People's Bank of China, operating under direct instructions from Xi Jinping's Economic Security Council, a body so secretive that most Western analysts did not even know it existed until 2023. And what happened next is going to reshape the financial world that every American depends on for the value of their savings, their retirement accounts, and the purchasing power of every dollar they earn. Right now, as you watch this, the United States government owes more than $36.8 trillion in national debt. That is not a projection. That is the number published by the Treasury Department as of March 2026. To put in perspective, that is more than the entire annual economic output of the United States, the European Union, and Japan combined. It is a number so large that it has lost all meaning to most Americans. It is just a big number. Abstract, distant, somebody else's problem, but it is not abstract. It is not distant, and it is not somebody else's problem. Because the way that debt is financed, whom holds it, and what they choose to do with it is the single most important factor determining whether your dollar buys a loaf of bread tomorrow or half a loaf. Right now, as you watch this, the United States government owes more than $36.8 trillion in national debt. That is not a projection. That is the number published by the Treasury Department as of March 2026. To put in perspective, that is more than the entire annual economic output of the United States, the European Union, and Japan combined. It is a number so large that it has lost all meaning to most Americans. It is just a big number. Abstract, distant, somebody else's problem, but it is not abstract. It is not distant, and it is not somebody else's problem. Because the way that debt is financed, whom holds it, and what they choose to do with it is the single most important factor determining whether your dollar buys a loaf of bread tomorrow or half a loaf. Stay with me because what I am about to show you connects decisions made in Beijing to the interest rate on your mortgage, the price of gas at your local station, and the value of the retirement account you are counting on for your future. And the revelation at the end of this video about what China has been doing with its treasury holdings over the past 18 months will fundamentally change how you understand the financial relationship between the world's two largest economies. We're going to walk through this step by step. Every financial mechanism, every strategic decision, every documented transaction, and when all of it is laid out in front of you, the picture that emerges is not just concerning. It is historic. Let us begin at the foundation. The United States government spends more money than it collects in taxes. This has been true in all but 4 years since 1970. The gap between what the government spends and what it collects is called the deficit. In fiscal year 2025, that deficit was $1.83 trillion. $1.83 trillion that the federal government needed to borrow from somebody in order to keep operating. The way it borrows is by selling Treasury securities. Think of them as IOUs. The government says, give me $10,000 today, and I will pay you back $10,000 plus interest in 10 years or 30 years or 2 years or 3 months, depending on the type of security. These Treasury securities are considered the safest investment in the world because they are backed by the full faith and credit of the United States government. The assumption has always been that the U.S. government will never default. It will always pay its debts. And for 250 years, that assumption has held. But assumptions are not guarantees. And the mechanics of who buys those Treasury securities and why, and what happens when they stop buying, is the story that most Americans have never been told. For decades, the two largest foreign holders of U.S. Treasury securities were China and Japan. At their peak in 2013, China held approximately $1.32 trillion in U.S. Treasuries. Japan held roughly $1.18 trillion. Together, these two nations held more than $2.5 trillion of American government debt. They were, in effect, America's most important creditors. Now here is the question that most people never think to ask. Why? Why would China lend trillions of dollars to the United States? The answer is not generosity. The answer is the mechanics of the global trade system. China runs a massive trade surplus with the United States. In 2024, that surplus was $295 billion. That means American consumers and businesses paid $295 billion more for Chinese goods than Chinese consumers and businesses paid for American goods. Those dollars flow into China's banking system. The People's Bank of China accumulates them. And because there are only a limited number of things you could do with hundreds of billions of US dollars, the PBOC historically invested them in the safest, most liquid dollar-denominated asset available, US Treasury securities. The way it borrows is by selling Treasury securities. Think of them as IOUs. The government says, give me $10,000 today, and I will pay you back $10,000 plus interest in 10 years or 30 years or 2 years or 3 months, depending on the type of security. These Treasury securities are considered the safest investment in the world because they are backed by the full faith and credit of the United States government. The assumption has always been that the U.S. government will never default. It will always pay its debts. This created a symbiotic relationship that economists called Chimerica. China manufactured goods cheaply. America consumed those goods in enormous quantities. The dollars America paid for those goods flowed to China. China lent those dollars back to America by buying Treasury bonds. The Treasury bond purchases kept interest rates low. Low interest rates allowed Americans to borrow more, consume more, buy more Chinese goods. And the cycle continued. It was, in effect, a financial perpetual motion machine. China got an export-driven economy that lifted 800 million people out of poverty. America got cheap goods and cheap borrowing. Wall Street got massive asset appreciation. Everyone appeared to win. But there was a structural vulnerability built into the machine from the beginning. And that vulnerability is now being exploited. The vulnerability is this. When a foreign nation holds $1 trillion of your government's debt, they have leverage, not military leverage, financial leverage, the kind that does not make headlines until it is too late. Because the day they decide to stop buying, or worse, to start selling, the mechanics of the Treasury market change in ways that directly affect every American household. And China has decided. Between January 2022 and March 2026, China reduced its holdings of U.S. Treasury securities from $1.07 trillion to approximately $770 billion. That is a reduction of $300 billion in 4 years. Not $300 million. $300 billion. That is roughly equivalent to the entire GDP of Ireland, removed from the Treasury market over 4 years. Now, this was not done with a single dramatic announcement. There was no financial Pearl Harbor. No Beijing official went on television to declare that China was dumping American debt. That would have been catastrophic because a sudden massive sale would have crashed the bond market, spiked interest rates overnight, and triggered a global financial panic. And since China still holds $770 billion in treasuries, they would have destroyed the value of their own remaining holdings. No, this was done the way China does most things, gradually, methodically, deliberately, across 48 months, in increments small enough to be absorbed by the market without triggering a crisis, but large enough that when you step back and look at the trend line, the direction is unmistakable. And here's the part that should make every American who pays a mortgage or carries a car loan sit up and pay attention. When foreign buyers reduce their purchases of Treasury securities, someone else has to buy them because the government is still running a $1.83 trillion annual deficit. The bonds still need to be sold. The money still needs to be borrowed. So who fills the gap? 3 sources. First, domestic institutions. American banks, pension funds, insurance companies, and mutual funds. But they have their own constraints. Bank capital requirements limit how many treasuries they can hold. Pension funds are already overweight in bonds. Insurance companies have duration matching requirements that constrain their flexibility. Second, the Federal Reserve. The Fed can buy Treasury securities through what is known as quantitative easing, which is a sophisticated way of saying they create new money electronically and use it to purchase government bonds. But the Fed is currently running quantitative tightening, doing the opposite, reducing its balance sheet by letting its existing Treasury holdings mature without replacement. The Fed bought $5 trillion in Treasuries between 2020 and 2022 to finance the pandemic response. They are now trying to unwind that. They are not in a position to be the buyer of last resort right now. Third, Other foreign buyers. But here is the problem. The other major foreign buyers, Japan, the United Kingdom, Belgium, Luxembourg, the Cayman Islands, these are small or have their own fiscal constraints. Japan has been reducing its holdings as well, from $1.27 trillion to $1.06 trillion over the same period. The United Kingdom's holdings fluctuate based on custody arrangements for third-party accounts. Belgium's holdings are primarily a function of Euroclear, the bond clearing system, not Belgian sovereign investment. The bottom line is this. China is reducing its treasury purchases. Japan is reducing its treasury purchases. The Fed is not buying. Domestic institutions have limited capacity, and the deficit is $1.83 trillion and growing. This is the equation that determines the interest rate on your next mortgage, the yield on your retirement fund, and the cost of every dollar the federal government borrows to finance Social Security, Medicare, defense spending, and infrastructure. When there are fewer buyers for a given supply of bonds, the price of those bonds falls. When bond prices fall, yields rise. When yields rise, interest rates across the entire economy rise. Not because the Federal Reserve decided to raise rates, not because inflation increased, but because the marginal foreign buyer who was suppressing interest rates for decades decided to step back. The 10-year Treasury yield has risen from 1.5% in January 2022 to 4.3% in March 2026. Part of that increase is the Federal Reserve's rate hiking cycle, but part of it, and this is the part that very few analysts are willing to say publicly, is the structural decline in foreign demand for Treasury securities. When China reduces purchases by $300 billion and Japan reduces purchases by $200 billion, that is $500 billion in annual demand that has to be replaced by someone willing to accept a higher yield. Now let us talk about where that money went. Because China did not simply sell treasuries and pile the cash in a vault in Beijing. They deployed it, and where they deployed it tells you exactly what their strategic calculus is. Gold. The People's Bank of China has been the world's largest single buyer of gold for 3 consecutive years. Official purchases totaled 231 tons in 2025 alone, with analysts estimating the true figure is closer to 300 tons when accounting for unreported purchases. Central bank swap lines. China has established bilateral currency swap agreements with over 40 countries, allowing trade to be conducted in yuan rather than dollars. The total value of these swap lines exceeds $500 billion equivalent. Belt and road infrastructure. China has deployed hundreds of billions of dollars in infrastructure loans across Asia, Africa, and Latin America. These loans are denominated in yuan and repayable in local currencies or commodity deliveries, not dollars. Each loan creates a node in a trade network that operates independently of the dollar clearing system. The mBridge digital currency project. China, Thailand, the UAE, Saudi Arabia, and Hong Kong have developed a cross-border central bank digital currency platform that allows real-time settlement of international transactions without touching the SWIFT network or the dollar clearing system. This project went from pilot to operational in 2024. Each of these deployments has a common characteristic. They reduce global dependence on the dollar, not by attacking the dollar directly, not by refusing to use it, but by building alternative infrastructure that makes the dollar optional rather than mandatory. This is the strategy that military theorists call the 1,000 cuts. No single action is dramatic enough to trigger a crisis response. Each individual step is defensible, reasonable, even logical from a risk management perspective. But the cumulative effect across years and across multiple simultaneous initiatives is the gradual erosion of the structural advantage that has underpinned American financial power since 1945. Now, here is where most analysis of China's treasury reduction stops. Most commentators present it as financial diversification, as risk management, as a natural consequence of trade tensions and sanctions concerns. But there is a deeper strategic dimension that very few people are discussing, and it requires understanding what happened to Russia in February 2022, when the United States and its allies froze $300 billion in Russian central bank reserves held in Western financial institutions. They demonstrated something that China had suspected but never seen proven. They demonstrated that dollar-denominated reserves held in Western banks are not sovereign assets. They are hostages. Russia held those reserves in dollars, euros, pounds, and yen in accounts at Western central banks and commercial institutions. When the invasion of Ukraine began, those reserves were frozen overnight by executive order. No court hearing, no due process, no appeal mechanism. A sovereign nation's financial reserves, accumulated over decades by selling oil and gas on the global market, rendered inaccessible by a political decision made in Washington, Brussels, and London. Now put yourself in Xi Jinping's shoes for a moment. You're watching this happen in real time. You hold $1.07 trillion in the exact same type of assets, held in the exact same type of institutions, subject to the exact same legal jurisdiction. The message from Washington could not be clearer. If you cross a line we define, we will do to you what we did to Russia. The Chinese leadership drew two conclusions from the Russia sanctions. First, dollar reserves are a strategic vulnerability, not a strategic asset, if you're a nation that might find itself in geopolitical conflict with the United States. Second, the timeline for reducing that vulnerability is measured in years, not decades, because the precedent has now been set and the mechanism has been demonstrated. That is why $300 billion in treasuries have been sold over 4 years. That is why gold purchases have accelerated. That is why the mBridge digital currency platform was fast-tracked from pilot to operational. That is why belt and road loans are denominated in yuan. That is why swap lines have been expanded to 40 countries. This is not diversification. This is strategic de-risking, and it is being conducted with the same systematic precision that characterizes Chinese state planning across every domain. Now let's talk about Taiwan, because Taiwan is the context that transforms China's treasury reduction from a financial story into a geopolitical story of existential consequence for the United States. If China decides to move on Taiwan, whether through blockade, economic coercion, or military force, the United States has indicated through multiple administrations, though never with an explicit treaty obligation, that it would respond. The nature and scale of that response is deliberately ambiguous. That ambiguity is the deterrent. But deterrence only works if the consequences of aggression are severe enough to outweigh the benefits. And here is the calculus that keeps Pentagon planners and Treasury officials awake at night. If China moves on Taiwan and the United States responds with sanctions similar to those imposed on Russia, what happens? The United States freezes $770 billion in Chinese Treasury holdings. China retaliates by dumping whatever treasuries it has not already sold. The bond market convulses. Interest rates spike. The dollar drops against every major currency. Every American with a mortgage, a car loan, or a credit card balance feels it within weeks. But here is the asymmetry. Russia's economy was $1.7 trillion when sanctions were imposed. Russia provided 10% of global oil and 40% of European natural gas. The disruption was significant but manageable for the West, at enormous cost but manageable. China's economy is $18.5 trillion. China is the manufacturing base for the global economy. China provides 80% of global rare earth processing, 75% of global lithium-ion battery production, 60% of global solar panel manufacturing, and manufactures components that are embedded in virtually every electronic device, automobile, and piece of medical equipment on Earth. Sanctioning China the way the West sanctioned Russia would be the economic equivalent of the United States sanctioning itself. The disruption would not be a recession. It would be an economic reorganization of a scale that the modern world has never experienced. And China knows this. That is why they are reducing their treasury exposure. Not because they want to crash the dollar, but because they want to ensure that when the day comes, if it comes, when Washington has to decide whether to impose sanctions or stand down, the financial weapon that worked against Russia will not work against China with the same effectiveness. Every $1 billion of treasuries that China sells is $1 less billion of leverage that Washington holds. Every gold bar that Beijing adds to its reserves is one more unit of a reserve asset that cannot be frozen by executive order. Every swap line denominated in yuan is one more trade relationship that operates outside the dollar system. The strategic logic is not complicated. It is elegantly simple. Make the dollar weapon weaker by reducing your exposure to it, while simultaneously making the counterstrike, the disruption of Chinese manufacturing to the global economy, more painful. This is financial deterrence, and It is being built methodically, transparently, in full view of anyone who reads the Treasury International Capital data published by the US Treasury Department every single month. The data is public. The trend is clear. And yet, most Americans have no idea it is happening because the evening news does not explain Treasury International Capital flows, and financial literacy is not a priority in American education. Now, I want to bring this down from the geopolitical level to your kitchen table, because this is not an abstract story about great power competition. This is a story about the cost of your life. When foreign demand for Treasury securities declines, the U.S. government has to offer higher yields to attract buyers. Higher yields mean higher interest rates across the economy. Higher interest rates mean your 30-year mortgage costs more, your car loan costs more, your credit card balance costs more, your student loans cost more. The average 30-year fixed mortgage rate in the United States is 6.9% as of March 2026. In January 2021, it was 2.65%. The monthly payment on a $400,000 mortgage at 2.65% is $1,609. The monthly payment on the same mortgage at 6.9% is $2,637. That is $1,028 more per month, $12,336 more per year for the exact same house. And it is not just mortgages. Interest costs on the national debt itself have reached $1.14 trillion annually. That is money the government spends not on schools, not on roads, not on defense, not on Social Security, just on interest, just on servicing the debt that it has already accumulated. And every percentage point increase in the average interest rate on that debt adds hundreds of billions in additional annual costs. This is the direct mechanism by which decisions made in Beijing's Zhongnanhai compound affect the household budget of a family in Omaha, Nebraska, or Columbus, Ohio, or Tampa, Florida, not through sanctions, not through tariffs, not through military confrontation, through the quiet, steady, entirely legal process of buying fewer of America's IOUs. If you have made it this far in this video, you already understand more about the real mechanics of American financial vulnerability than the vast majority of the people who will vote in the next election. You understand that the dollar's strength is not a law of nature. It is a function of demand. And demand is shifting. The financial architecture that has sustained American economic dominance since 1945 was built on three pillars: the Bretton Woods Agreement, the Petrodollar system, and the recycling of global trade surpluses into U.S. Treasury securities. Bretton Woods collapsed in 1971 and was replaced by the petrodollar system. The petrodollar system is fracturing as Saudi Arabia diversifies its settlement currencies. And now, the third pillar, the recycling of trade surpluses into treasury purchases, is eroding as China systematically reduces its holdings. The question is not whether the architecture is changing. The data has already answered that question. $300 billion in Chinese treasury reductions, $200 billion in Japanese reductions, gold purchases at 55-year highs, digital currency alternatives going operational, yuan swap lines spanning 40 countries. The question that history will pose to this generation of Americans is not whether they watched the financial architecture shift. It is whether they understood what that shift meant for the world their children would inherit. The financial media will catch up to this story. Eventually, the mainstream news will connect these dots. Eventually, the political establishment will address the structural vulnerability of dependence on foreign creditors, financing permanent deficits. Eventually, but by the time they do, the positions will already have been taken. The alternatives will already have been built. The leverage will already have shifted. This is not a crisis that announces itself with a crash. This is a transition that reveals itself in increments, in quarterly TC data, in central bank gold reports, in swap line announcements buried in the financial press. The architecture of global financial power is being quietly, legally, methodically redrawn. And the only question that matters is whether you understand what you're looking at. The world is being reorganized. The geography of financial power is being redrawn. And right now, in this moment, the decision about whether you are ahead of that shift or behind it is yours alone. There is another dimension to this story that requires specific attention because it connects China's treasury reduction to a technology competition that most Americans are only vaguely aware of. Semiconductors. Taiwan's Semiconductor Manufacturing Company, TSMC, manufactures approximately 92% of the world's most advanced semiconductor chips. These chips power every iPhone, every GPU that runs artificial intelligence systems, every advanced military radar, every satellite communication system, and every autonomous weapons platform in development. Without TSMC's chips, the American technology industry does not function. The American military's technological edge does not exist. The artificial intelligence race that the Department of Defense considers existential is over before it begins. TSMC is located on an island 100 miles off the coast of China that China claims as sovereign territory. Now connect this to the Treasury story. China is reducing its financial exposure to American sanctions. It is building alternative payment systems. It is accumulating gold that cannot be frozen. It is constructing trade networks that bypass the dollar. And the most plausible scenario in which the United States would deploy the full spectrum of its financial weapons against China is a Taiwan contingency. The semiconductor dimension transforms the treasury reduction from a financial story into a technology story, into a military story, into an existential story about the future of American technological supremacy. Because if China moves on Taiwan, the United States faces a choice that has no good options. Respond militarily and risk a great power conflict. Respond with sanctions and trigger the economic disruption I described earlier, while simultaneously losing access to the world's most critical semiconductor manufacturing. Or do not respond and watch American technological dominance evaporate as China absorbs the world's most important foundry. China's treasury reduction is positioning for this exact choice. By reducing financial exposure, China is ensuring that the sanctions option is weakened. By building alternative systems, China is ensuring that Chinese trade and finance can continue even under maximum pressure. By accumulating gold, China is ensuring that its reserves retain value regardless of what happens to the dollar. This is not diversification. This is strategic de-risking, and it is being conducted with the same systematic precision that characterizes Chinese state planning across every domain. This is not diversification. This is preparation. And the preparation is being conducted with the same meticulous, decade-spanning strategic patience that has characterized Chinese state planning since Deng Xiaoping's reforms in 1978. Now, let me address a counter-argument that sophisticated viewers may be formulating. You might be thinking, the dollar is still the world's reserve currency. It still accounts for 58% of global reserves and 88% of global foreign exchange transactions. China's yuan accounts for less than 3% of global reserves. The shift you are describing is real, but marginal. That is a fair point, and it deserves an honest response. The dollar's dominance is not going to collapse tomorrow. There is no imminent crisis. The dollar remains the deepest, most liquid, most widely accepted currency in the world. American capital markets remain the most transparent, most accessible, and most legally protected in the world. These are genuine structural advantages that no rival currency currently matches. But here is the distinction that matters. The relevant question is not whether the dollar will be replaced. The relevant question is whether the dollar's structural advantages are eroding at the margin, and whether that marginal erosion compounds over time in ways that eventually become non-marginal. In 2001, the dollar accounted for 71% of global central bank reserves. In 2015, it was 66%. In 2020, it was 63%. In 2025, it is 58%. That is a decline of 13 percentage points in 24 years. Not a collapse, a trend. And trends, by their nature, compound. Every percentage point of reserve share that the dollar loses represents approximately $120 billion in reduced global demand for dollar assets. Across 13 percentage points, that is roughly $1.5 trillion in structural demand that has shifted away from the dollar over 2 decades. That demand does not disappear. It goes somewhere. And increasingly, it is going to gold, to yuan-denominated assets, to euros, and to the new digital currency infrastructure that China, is building. When the dollar accounted for 71% of global reserves, the United States could run perpetual deficits with minimal consequences because global demand for dollar assets was so overwhelming that it absorbed whatever the Treasury issued. As that share declines toward 50% and potentially below, the cushion shrinks. The ability to run deficits without consequences diminishes. The interest rate that the government must offer to attract foreign buyers increases. This is not a prediction of collapse. This is a description of a mechanism that is documentable, quantifiable, and already in motion. Let me bring this back to you one more time, because the ultimate test of any geopolitical analysis is whether it connects to the life of the person watching. If you're a 35-year-old American with a 401k retirement account, the value of that account at your retirement in 2056 depends critically on the structural demand for dollar assets over the next 30 years. If global demand for dollars weakens, interest rates rise structurally, bond values decline, the cost of capital for American corporations increases, corporate earnings are pressured, and stock market returns over your investment horizon are lower than the historical average that your retirement planning assumes. The historical average real return of the S&P 500 is approximately 7% per year. That average was generated during a period when the dollar's reserve status was unchallenged, when foreign capital flowed into American assets at unprecedented volumes, and when interest rates were suppressed by massive foreign treasury purchases. If any of those conditions change meaningfully, the future average could be lower, not necessarily dramatically lower, but 5% instead of 7% compounds to a vastly different retirement balance over 30 years. A $500 monthly contribution at 7% for 30 years produces approximately $566,000. At 5%, it produces approximately $399,000. That is $167,000 difference from a 2 percentage point change in average returns. That is the kitchen table version of what happens when global reserve managers in Beijing and Riyadh and New Delhi and Brasilia gradually shift their allocations away from dollar assets. It does not show up as a crisis. It shows up as a slightly lower return on your retirement account, compounding over decades until the day you retire and discover that the future you planned for assumed conditions that no longer existed. I do not tell you this to frighten you. I tell you this because understanding the mechanism is the first step toward making informed decisions about your financial future. And most people do not understand the mechanism because nobody explains it to them in these terms. The decisions being made in Beijing's Zongnanhai compound right now, today, this month, this year, are decisions that will echo through the financial lives of Americans for decades, not through dramatic crisis, through the quiet, gradual, entirely predictable consequences of a great power adjusting its financial relationship with the existing global hegemon. Gold at $3,087 per ounce. The dollar's reserve share at 58% and declining. Chinese Treasury holdings at $770 billion and declining. The mBridge digital currency platform operational. Belt and road loans denominated in yuan. 40 bilateral swap lines bypassing the dollar. And the Taiwan question hanging over all of it like a shadow that neither Washington nor Beijing is willing to address directly. That is why $300 billion in treasuries have been sold over 4 years. That is why gold purchases have accelerated. That is why the mBridge digital currency platform was fast-tracked from pilot to operational. That is why belt and road loans are denominated in yuan. That is why swap lines have been expanded to 40 countries. Gold at $3,087 per ounce. The dollar's reserve share at 58% and declining. Chinese Treasury holdings at $770 billion and declining. The mBridge digital currency platform operational. Belt and road loans denominated in yuan. 40 bilateral swap lines bypassing the dollar. And the Taiwan question hanging over all of it like a shadow that neither Washington nor Beijing is willing to address directly. The architecture is shifting. The data confirms it. The trend is clear. And the only variable is whether you see it now, while the shift is gradual and the adjustments are still possible, or whether you see it later, when the consequences have already been priced in and the opportunity to prepare has passed. This is financial deterrence, and it is being built methodically, transparently, in full view of anyone who reads the Treasury international capital data published by the US Treasury Department every single month. The data is public. The trend is clear. And yet, most Americans have no idea it is happening because the evening news does not explain Treasury international capital flows, and financial literacy is not a priority in American education. The architecture is shifting. The data confirms it. The trend is clear. And the only variable is whether you see it now, while the shift is gradual and the adjustments are still possible, or whether you see it later, when the consequences have already been priced in and the opportunity to prepare has passed. The world is being reorganized. The geography of financial power is being redrawn. And right now, in this moment, the decision about whether you're ahead of that shift or behind it is yours alone. The world is being reorganized. The geography of financial power is being redrawn. And the question for every American watching this is straightforward. Do you understand what you're looking at? Because now you do. There is one final dimension that demands attention. The dimension that connects everything we have discussed into a unified strategic picture. And it is the dimension that most Americans find most difficult to comprehend because it requires understanding something about China that most Western analysts consistently underestimate. Time horizons. The United States operates on electoral cycles. Every 2 years, a new Congress convenes. Every 4 years, a new president potentially takes office. Policy priorities shift. Strategies are revised. Positions are reversed. What one administration builds, the next may dismantle. The Iran nuclear deal was negotiated, then withdrawn from, then renegotiated. The Trans-Pacific Partnership was designed, then abandoned, then partially reconstituted under different terms. America's strategic consistency is constrained by the fundamental structure of its democratic process. China operates on a different clock. The Belt and Road Initiative was announced in 2013 and is being implemented across a 30-year timeline. The Made in China 2025 technology strategy was published a decade ago, and its industrial targets are being systematically achieved. The military modernization program that is transforming the People's Liberation Army into a force capable of contesting American naval supremacy in the Western Pacific was initiated in 1999 and will reach its stated objectives by 2035. The reunification of Taiwan is described in Chinese strategic documents as a task to be completed by 2049, the centennial of the People's Republic. These are not campaign promises. These are state planning documents implemented across administrations, across leadership transitions, across decades. The Politburo Standing Committee changes every 5 or 10 years, but the strategic direction does not. When China reduces its treasury holdings by $300 billion over 4 years, that is not a reaction to a tariff or a sanctions threat. That is a 4-year increment of a multi-decade strategic repositioning. When China establishes 40 bilateral swap lines, that is not a response to a news cycle. That is infrastructure building for a financial system designed to operate independently of the dollar by mid-century. And this temporal mismatch is perhaps the most dangerous vulnerability in the American strategic position, because the United States responds to Chinese moves as individual events. Each treasury reduction is analyzed in isolation. Each swap line is reported as a standalone story. Each gold purchase is covered as a quarterly data point. The media treats each development as news, processes it through the 24-hour information cycle, and moves on. China does not think in news cycles. China thinks in decades. And the cumulative effect of dozens of individually modest, individually defensible strategic moves executed consistently across decades is a transformation that is invisible while it is happening and irreversible by the time it is recognized. This is the most important insight of this entire analysis. Not the treasury numbers, not the gold purchases, not the digital currency platforms. The insight is temporal. The insight is that America is playing a game measured in election cycles, while China is playing a game measured in generations. And in that temporal mismatch lies the explanation for everything I have shown you today. Why is China calmly, methodically, gradually reducing its treasury exposure rather than dumping it all at once, because they have 20 years to complete the transition. There is no urgency. Each year, they redirect $50 to $100 billion from dollar assets to gold, yuan infrastructure, and belt and road investments. After 10 years, the exposure is halved. After 20 years, it is negligible. No crisis required. No drama required. No confrontation required. Why are they building mBridge and swap lines and yuan-denominated loan facilities? Because these systems need 10 to 15 years to reach critical mass. A payment system is useless with 3 participants. It becomes transformative with 40 participants. And by 2035, if the trajectory continues, the yuan settlement infrastructure will be comprehensive enough to handle a significant portion of global trade without touching the dollar system. Why are they buying gold at record levels? Because gold is insurance against the scenario in which the transition becomes confrontational rather than gradual. If the United States respond to China's financial repositioning with aggressive countermeasures, gold is the reserve asset that cannot be frozen, sanctioned, or devalued by any single government. Each of these strategies is individually rational, individually modest, individually defensible. Together, executed across decades, they represent the most significant deliberate challenge to the dollar-based financial order since the Bretton Woods Conference of 1944. And the challenge is being executed not through aggression, but through patience. Let me close with a thought about what this means for you. Not for the financial system, not for the geopolitical order, for you. If you are an American with savings denominated in dollars, with a retirement account invested in dollar-denominated assets, with a home valued in dollars, with a salary paid in dollars, then the value of everything you own depends on the structural demand for the currency in which those assets are denominated. That demand has been guaranteed for 80 years by the architecture I have described: the Bretton Woods system, the petrodollar, the Treasury recycling mechanism. 3 pillars that collectively ensured that the world needed dollars not because they wanted them, but because the system required them. The financial architecture that has sustained American economic dominance since 1945 was built on 3 pillars: the Bretton Woods Agreement, the petrodollar system, and the recycling of global trade surpluses into US Treasury securities. Bretton Woods collapsed in 1971 and was replaced by the petrodollar system. The petrodollar system is fracturing as Saudi Arabia diversifies its settlement currencies. And now, the 3rd pillar, the recycling of trade surpluses into treasury purchases, is eroding as China systematically reduces its holdings. If you're an American with savings denominated in dollars, with a retirement account invested in dollar-denominated assets, with a home valued in dollars, with a salary paid in dollars, then the value of everything you own depends on the structural demand for the currency in which those assets are denominated. That demand has been guaranteed for 80 years by the architecture I have described: the Bretton Woods system, the petrodollar, the Treasury recycling mechanism. 3 pillars that collectively ensured that the world needed dollars not because they wanted them, but because the system required them. 2 of those 3 pillars are now demonstrably weakening. Bretton Woods ended 55 years ago. The petrodollar exclusivity has been broken. The Treasury recycling mechanism is eroding. The 3rd pillar, the depth and liquidity and legal infrastructure of American capital markets, remains strong. But 1 pillar cannot sustain a structure designed to rest on 3. The transition will not be dramatic. You will not wake up one morning and find that your dollars are worthless. That is not how reserve currency transitions work. They work gradually. The pound sterling was the world's reserve currency for over a century. Its transition to a secondary currency took approximately 30 years, from the 1920s to the 1950s. During that transition, the British experienced persistent inflation, declining real wages, and a standard of living erosion that was imperceptible year by year, but transformative across a generation. That is the pattern, not a crisis, a drift, a gradual decline in purchasing power that shows up not in dramatic events, but in the quiet accumulation of things getting a little more expensive every year, returns being a little lower every decade, and the comfortable assumptions of permanent prosperity becoming a little less comfortable with each passing administration. That is the kitchen table version of what happens when global reserve managers in Beijing and Riyadh and New Delhi and Brasilia gradually shift their allocations away from dollar assets. It does not show up as a crisis. It shows up as a slightly lower return on your retirement account, compounding over decades until the day you retire and discover that the future you planned for assumed conditions that no longer existed. That is the pattern, not a crisis, a drift, a gradual decline in purchasing power that shows up not in dramatic events, but in the quiet accumulation of things getting a little more expensive every year, returns being a little lower every decade, and the comfortable assumptions of permanent prosperity becoming a little less comfortable with each passing administration. Understanding that pattern, recognizing it while it is happening rather than after it has happened, is the only advantage available to any individual navigating a systemic transition. You cannot stop the transition. You cannot change the decisions being made in Beijing, but you can understand what those decisions mean for the world your money exists in. And understanding is the prerequisite for every rational decision that follows. The world is being reorganized. The geography of financial power is being redrawn. And right now, in this moment, the decision about whether you're ahead of that shift or behind it is yours alone. The world is being reorganized. The geography of financial power is being redrawn. And the question for every American watching this is not whether the shift is real, because the data has settled that question, but what you choose to do with the understanding. Let me add one more layer to this analysis, because there is a mechanism that very few people discuss that makes China's Treasury reduction even more strategically significant than the raw numbers suggest. And that mechanism is called the interest rate multiplier effect. When China reduces its Treasury holdings by $300 billion, the direct effect is that $300 billion worth of bonds need to find new buyers. But the indirect effect is much larger, because the Treasury market, like all financial markets, operates on marginal pricing. The price and yield of Treasury securities are not determined by the total stock of holdings. They're determined by the marginal buyer, the buyer at the edge, the buyer who is deciding right now whether to purchase the next bond at the current yield or demand a higher yield. For decades, China and Japan were the dominant marginal buyers. They absorbed the incremental supply of new Treasury issuance with such reliability that the market could count on their demand. This reliability compressed term premium, the extra yield that investors demand for holding longer duration bonds instead of rolling over short-term ones. Term premium on the 10-year Treasury was actually negative for much of the 2010s, meaning investors were willing to accept lower yields on long-term bonds and short-term ones simply because they were so confident in the demand. When a marginal buyer steps back, the term premium rises. And the term premium increase affects not just Treasuries. It ripples through every interest rate-sensitive asset in the economy. Corporate bond yields rise. Mortgage rates rise. Auto loan rates rise. Credit card rates rise. The cost of capital for every business in America increases, which reduces investment, which reduces hiring, which reduces growth. The Federal Reserve Bank of New York publishes a term premium model called the ACM model. That model shows the 10-year term premium rising from minus 0.5% in 2020 to plus 0.7% in early 2026, a swing of 1.2 percentage points on a $36.8 trillion debt. A 1.2 percentage point increase in the average interest rate adds approximately $440 billion in annual interest costs. That is $440 billion per year that the government spends not on education, infrastructure, defense, or healthcare, but purely on the increased cost of financing existing debt. And that cost is being driven in significant part by the structural decline in foreign marginal demand for Treasury securities. It is a cost that every American taxpayer bears, not through a visible tax increase, through the invisible mechanism of higher interest rates, higher government borrowing costs, and the resulting constraints on federal spending that affect programs Americans depend on. The Congressional Budget Office projects that by 2034, interest costs on the national debt will exceed $1.7 trillion annually, making it the single largest category of federal spending, larger than defense, larger than Social Security, larger than Medicare. And that projection assumes no further deterioration in foreign demand for treasuries, leading to additional term premium increases. If China's Treasury reduction continues at its current pace, And if other central banks follow the diversification trend, the CBO's projections may prove optimistic. The structural demand cushion that allowed the United States to run enormous deficits at low interest rates for decades is thinning. And once it thins enough, the mathematics of compound interest on a $36.8 trillion debt become ruthlessly unforgiving. This is not speculation. This is arithmetic. And the arithmetic does not care about politics, partisanship, or ideology. It cares only about the relationship between the supply of Treasury securities and the demand for them. And that relationship is shifting. Now here is my final thought on this subject, and it is a thought about responsibility. The information I have shared with you tonight is publicly available. Every number I have cited comes from official sources. The Treasury International Capital data is published monthly by the US Treasury Department. China's gold purchases are reported by the People's Bank of China and tracked by the World Gold Council. The dollar's reserve share is published quarterly by the IMF. The mBridge project is documented in publications by the Bank for International Settlements. The Congressional Budget Office projections are available on their website. None of this is secret. None of it is conspiracy. None of it is speculation. It is all published, documented, and verifiable. And yet most Americans have never heard any of it presented as a coherent narrative because the financial media covers each data point in isolation. Chinese treasury sales are news one day. Gold purchases are news another day. The dollar's reserve share is mentioned in a footnote. mBridge is covered in a fintech newsletter. The CBO interest projections appear in a congressional hearing transcript that nobody reads. The picture only becomes visible when you connect the dots, when you lay out the data points in sequence and read them not as isolated events, but as components of a deliberate, patient, methodical strategy executed by a nation that plans in decades while its competitor reacts in news cycles. That is what we have done tonight. Connect the dots. It is now your responsibility to decide what that picture means for you, your finances, and the future you're building. The world is being reorganized. The geography of financial power is being redrawn. And right now, in this moment, the decision about whether you're ahead of that shift or behind it is yours alone. This is financial deterrence, and it is being built methodically, transparently, in full view of anyone who reads the Treasury International Capital data published by the US Treasury Department every single month. The data is public. The trend is clear. And yet, most Americans have no idea it is happening because the evening news does not explain Treasury International Capital flows, and financial literacy is not a priority in American education. No, this was done the way China does most things. Gradually, methodically, deliberately, across 48 months, in increments small enough to be absorbed by the market without triggering a crisis, but large enough that when you step back and look at the trend line, the direction is unmistakable. The world is being reorganized. The geography of financial power is being redrawn. The data is clear. The trend is unmistakable. And the consequences will compound across decades, regardless of whether anyone in Washington acknowledges them today or acknowledges them eventually, after the moment has already passed and the positions have already been taken. There is one more piece of evidence that deserves specific attention, because it is the piece that transforms everything I have discussed from analysis into action, from strategic abstraction into a personal financial decision that you may face in the next few years. The BRICS nations, Brazil, Russia, India, China, and South Africa, expanded their membership in January 2024 to include Egypt, Ethiopia, Iran, Saudi Arabia, and the United Arab Emirates. The expanded bloc represents roughly 45% of the world's population and approximately 37% of global GDP in purchasing power parity terms. At the BRICS summit in Kazan, Russia, in October 2024, the bloc announced a cross-border payment system based on central bank digital currencies that would allow member nations to settle trade directly in their own currencies without converting through the dollar. The system uses distributed ledger technology and is designed to be sanctions-resistant by architecture. There is no central point of control that any single government can freeze, redirect, or shut down. Saudi Arabia, the nation that made the petrodollar possible in 1974, is now a member of the bloc that is building the payment infrastructure to make the petrodollar optional. The United Arab Emirates, America's closest military partner in the Gulf, is a co-developer of the mBridge digital currency platform that bypasses SWIFT and dollar clearing. Think about what that means. The two Gulf monarchies that have been the cornerstone of the dollar's energy pricing monopoly for half a century are now actively participating in building the financial infrastructure that gives them the option to price oil in something other than dollars. They have not switched yet, but they are building the switch. And the distinction between having a switch and flipping, it is simply a matter of timing and incentive. Every barrel of oil traded in yuan rather than dollars is 1 barrel's worth of dollar demand removed from the global system. At current prices of approximately $85 per barrel, and with Saudi Arabia producing 9.1 million barrels per day, if even 20% of Saudi oil sales shifted from dollar settlement to yuan or BRICS currency settlement, that would remove approximately $56 billion per year in dollar demand. Across the entire BRICS oil trade, the number could be several $100 billion annually. That is not enough to crash the dollar, but it is enough to affect the term premium on Treasury securities. It is enough to push interest rates incrementally higher, and it is enough to accelerate the trend that is already visible in the IMF's reserve composition data. This is where we are. March 2026. China reducing Treasury holdings. BRICS building alternative payment systems. The petrodollar's exclusivity broken. Gold at record highs. The dollar's reserve share at a 30-year low. Interest costs on the national debt exceeding $0.1 trillion annually. Right now, as you watch this, the United States government owes more than $36.8 trillion in national debt. That is not a projection. That is the number published by the Treasury Department as of March 2026. To put it in perspective, that is more than the entire annual economic output of the United States, the European Union, and Japan combined. It is a number so large that it has lost all meaning to most Americans. It is just a big number. Abstract. Distant. Somebody else's problem. This is where we are. March 2026. China reducing Treasury holdings. BRICS building alternative payment systems. The petrodollar's exclusivity broken. Gold at record highs. The dollar's reserve share at a 30-year low. Interest costs on the national debt exceeding $0.1 trillion annually. Each of these data points is publicly available. Each is independently verifiable. Together, they describe a structural shift in the global financial architecture that will affect the purchasing power of every dollar you earn, save, and invest for the rest of your financial life. The world is being reorganized. The geography of financial power is being redrawn. And right now, in this moment, the decision about whether you're ahead of that shift or behind it is yours alone. The world is being reorganized. The geography of financial power is being redrawn. And the question is whether you understand what you're looking at before the consequences become undeniable. Stay informed, think critically, and never stop asking who benefits, who pays, and who decided.